Howdy, Jacob here. Today we're looking at the company FIGS in the healthcare equipment and supplies industry. 1 billion at market cap, 733 million enterprise value. They are a healthcare apparel and lifestyle company in the US and internationally. So if you've ever seen nurses around or doctors, they're likely wearing their scrubs. Or maybe not likely. I don't know the amount of ownership or market share they have in it, but you've likely seen somebody with FIGS if you've seen a lot of nurses and doctors around. I know my wife is a nurse, and so I've definitely heard of the business. Founded in 2013, so pretty recently established company. Revenue growth out of this world. No surprise when COVID hit like crazy, and um, travel nurses were making a bunch and all that jazz. The demand for scrubs was also growing, and so their revenue growth is very positive, but it has dampened down a bit. So year-over-year revenue growth was as high as 138% in 2020 and has been down to 7.9% year-over-year in 2023. But they have had operating margins for some of those years, which is impressive for such a small business who's growing as much as they are. Gross margin being as impressive as they are is awesome. Return on invested capital, again, all over the place because sometimes positive earnings, sometimes negative earnings. And the numerator on that is your net operating profit. So makes sense that that's kind of all over the place. Income statement shows sales, general, and admin as the majority of their costs. No R&D, it's looking like. Balance sheet shows 247 million cash-like products with no short-term debt, no long-term debt, 96 million in total liabilities. So balance sheet looks fantastic. This would be a place where you could put a premium on your price to earnings and price to free cash flow based on them possibly getting greater returns through short-term investments or reinvesting through giving the shareholder a one-time dividend or buying back shares at hopefully a cheap price because they have more cash on hand than debt. Their cash flow statement shows good production of free cash flow, spending some good money on reinvesting. Otherwise, they just increased their cash balance for the last couple years. But so we don't see a long history. That's going to be something where I'll need an extra margin of safety. And then for capital allocation standpoint, we really only see a couple years of what they're truly doing with capital allocation, since here's just cash inflow, holding more cash, now turning to reinvestment. And so we're going to have to make some assumptions on capital allocation as well. So I'm going to assume a good amount of money is going towards share repurchase, is going to reinvestment and acquisitions. I'm not going to be assuming any share repurchases or dividend payout due to them not having it, and then no debt pay down because they don't have any long-term or short-term interest-bearing debt. And so let's go to making some assumptions here. On the revenue growth side, I'll probably be comfortable with 7%. I think that they've really had their big growth. I think there's still growth ahead of them, especially with all the reinvestment and acquisition growth that we have. I think 7% is honestly possibly being a bit conservative, but that's pretty comfortable to me. Let's do 14, 16% margin. Let's do 12 and 16%. I want a little bit more of a range here, but again, this is creating a story of what they're going to do with their money that's coming in. And now that they've made a good amount of net income and free cash flow, this is a 7-year perspective period we're looking at. I think they can really improve those bottom lines, especially with a 70% gross margin. Their share change, their stock-based compensation was about 40 million. That is going to be a good increase of shares, let's say about 4%. Again, this is assuming all share compensation goes to share issuance, which is obviously not the case, but this is just being, again, an extra level of conservatism. Terminal P, price to free cash flow, it's a small business. So actually, let's look at what their insider ownership is. We see insiders own 21% of the business. That's massive. That's big. So, growing business, but it is small, but, a lot of cash on hand. I'd feel comfortable with a 17 here, 15% return. Okay. And so, again, this is going to be a company with not a lot of history. You're going to have to create a little bit of a story here. Based on my initial analysis, it needs to fall 44%. So, honestly, not terribly far off. I think this would be a business I'd love to do a deeper dive on. Really look at the market share, how much of Scrubs or does FIGS own? How much do I think they can grow to? How much is the market actually growing? I mean, it's a great industry. I think even with um, AI and robots possibly becoming important figures in the health world. When it comes to nursing, I know my wife's a nurse, and so I think I understand how important just the human aspect of sympathy and everything is. That um, this is only a 7-year analysis, so I think even if AI and robotics becomes very popular, I don't think it'll be overtaken anytime in the next 7 years. Um, could I be wrong? I mean, absolutely. I can't predict that type of innovation, but based on this analysis, it's looking pretty, I mean, close-ish to a price that could make sense. And I think this is a good growth business. And so I do hope you enjoy this video and have a great rest of your day. Thank you.